Did you know that $1 today is worth less than $1 next year? It's not magic, it's inflation.
And right now, inflation is running hotter than it has in decades, eroding the purchasing power of your savings.
Many traditional savings accounts are losing money when you factor in inflation, meaning your money is actually shrinking.
In this video, we're going to break down exactly how to build a stock portfolio specifically designed to not just keep pace with inflation, but to beat it. By the end of this video, you'll know the asset allocation strategies, specific investment vehicles, and crucial mindset shifts needed to protect and grow your wealth in an inflationary environment.
We'll move beyond simply saving and into actively building a future where your money works for you. Let's start with understanding why traditional savings fail during inflation. Think of your savings account like a bucket with a small leak.
You're adding water, your deposits, but inflation is slowly draining it away. Typically, inflation averages around 3% per year, but recently we've seen it spike to over 9%. If your savings account yields 0.5%, you're losing 2.5% of your purchasing power annually, a silent tax on your wealth. Stocks, historically, have been the best hedge against inflation.
Since 1928, stocks have averaged a real return, that's return after inflation, of around 7 to 10% per year. This outperformance isn't accidental.
Companies can often raise prices during inflationary periods, maintaining or even increasing their profitability, which translates to higher stock prices. Consider Coca-Cola, they can adjust the price of a Coke to offset rising ingredient costs, protecting their margins.
But here's where it gets interesting, simply owning any stock isn't enough. A well-constructed portfolio needs diversification.
We need to think about different asset classes within the stock market and beyond. A portfolio heavily concentrated in one sector, like technology, might thrive in some environments, but could be vulnerable during others.
Let's talk about asset allocation.
A common starting point for a long-term, inflation-beating portfolio is the 60-40 rule, 60% stocks and 40% bonds.
However, in a high inflation environment, we need to tilt that balance.
Consider a 70-30 or even 80-20 allocation, favoring stocks. Within the stock portion, focus on value stocks, companies that are undervalued by the market, and companies with strong pricing power. Value stocks tend to perform better during inflationary periods because their current earnings are more heavily weighted in valuation. Now, let's get specific with investment vehicles. Instead of trying to pick individual stocks, which requires significant research and carries higher risk, consider exchange-traded funds, or ETFs. These are baskets of stocks that track a specific index, sector, or investment strategy. For broad market exposure, look at ETFs like the Vanguard Total Stock Market ETF, VTI, or the SPDR S&P 500 ETF Trust, SPY.
For value stocks, consider the Vanguard Value ETF, VTV.
These offer instant diversification at a low cost.
But don't stop at US stocks.
International stocks are crucial for diversification and can offer exposure to different economies and growth opportunities. Emerging markets, in particular, can provide a hedge against inflation as they often have faster economic growth rates.
The Vanguard FTSE Emerging Markets ETF, VWO, is a good option.
Remember, diversification isn't about eliminating risk, it's about reducing your exposure to any single risk.
Another often overlooked inflation hedge is real estate investment trusts, or REITs.
REITs own and operate income-producing real estate, like apartments, offices, and warehouses.
As inflation rises, rental income tends to increase, providing a stream of cash flow that can outpace inflation. The Vanguard Real Estate ETF, VNQ, offers broad exposure to the REIT market. Think of it like owning a piece of the rental market without the hassle of being a landlord.
But here's where it gets really interesting, inflation isn't just about rising prices, it's about expectations. If people expect inflation to remain high, they'll demand higher wages and prices, creating a self-fulfilling prophecy. This is why it's crucial to have a long-term perspective and avoid making emotional investment decisions based on short-term market fluctuations. The biggest mistake investors make during inflationary periods is panic selling. When the market dips, it's tempting to cash out and protect your losses.
However, selling during a downturn locks in those losses and prevents you from participating in the eventual recovery.
Historically, the stock market has always recovered from downturns, and often with strong returns.
Remember the dot-com bubble burst in the early 2000s? Or the financial crisis of 2008?
Both were followed by significant market rebounds.
So, what's the single most powerful insight? Building a portfolio that beats inflation isn't about timing the market, it's about time in the market. Consistent investing, diversification, and a long-term perspective are the keys to success. It's about building a system that allows your money to grow steadily over time, outpacing the eroding effects of inflation. Ultimately, the goal isn't just to preserve your wealth, but to grow it. Inflation is a reality, but it doesn't have to be a threat. By understanding the principles we've discussed today, you can take control of your financial future and build a portfolio that not only survives inflation, but thrives in it. If you found this information valuable, be sure to check out our video on the power of compound interest. It'll show you how to accelerate your wealth building journey. And remember, investing is a marathon, not a sprint. Stay disciplined, stay informed, and keep building towards a secure financial future.